Right, this video is going to talk about costs, some cost concepts from chapter 8. And we need to talk about cost because we're now looking at how firms behave. Earlier in the class, we were looking at how consumers behave. In this part of the class, we're looking at the behavior of firms. And firms, we're going to assume, are interested in profit. Profit is revenue minus cost. Profit is whatever firms earn in terms of when they sell their product, that's their revenue that they get from that, minus their costs. Profit ends up being counted as a residual. The way businesses generally have to work is they have to incur costs to produce goods or services to have to sell. So for instance, if you wanted to open a restaurant, you'd have to rent a suitable place with a kitchen and get the equipment for the kitchen and get the tables and everything and hire some staff and chefs and order and food and incur all of these costs, and then you'd be ready to open your restaurant and start selling some food and hopefully make some money. But there's no guarantee for that. And if, when you start operating it, if your revenue doesn't cover the cost, then you don't make a profit. The owner of a business gets to claim the profit, but the profit is a residual. It's whatever is left over. The owner is in effect agreeing to incur these costs, and if there's any, if they end up making any money, then the owner gets to claim it. Whereas other people who say, like the people who are whoever's renting that building to you for for you to run your restaurant, they get paid. You are going to pay them. When you hire employees, you agree to pay them whether anybody shows up to their restaurant, whether your restaurant makes any money or not. You're going to pay your employees. You're agreeing to do that. The owner gets to claim the profit. It's a residual. It's whatever is left over. So here in chapter 8, what we're doing is exploring the cost side of this equation. There are two types of costs that we could consider. One would be explicit costs, and the other would be implicit costs. Explicit costs are the costs that a business is going to incur. Sometimes some books will refer to these as out-of-pocket costs. These are the things that you actually have to pay. You'll be writing a check for or paying money for if you're running a business. So if you hire employees, there'll be an explicit cost. If you rent some tables and chairs for your restaurant, you're going to have to pay for that. And when you turn on the electric, you have the utilities operating in your restaurant, or you buy some food to prepare in your restaurant, those are going to be all explicit costs. You'll have invoices for them, you'll bill for them, and those will be part of the cost. But then there's also some costs that we have to think about that would be implicit. Because when we get down here to think about economic costs, and when we go back to chapters 1 and 2 of the book, we introduce the idea of opportunity costs. Opportunity costs is the full value of everything you give up when you produce something. We want to keep costs in that spirit. And to make sure that we get to the opportunity costs, we have to talk a little bit about implicit costs. Implicit costs would include the opportunity cost of some factors of production that are used in the operation of a firm, but factors of a production that may not have to actually be paid for. What do we mean by that? Well, the owners of a business will typically contribute some factors of production. They don't have to, but probably 99% of the time, especially when you start a business, if you're going to own a business, in all likelihood, you're going to work for that business too. That means that your labor is going to be you are going to be supplying labor at that firm. So if you're running a restaurant, it might be you're going to run the restaurant because you're a chef. And so you're going to be cooking the meals at your at your restaurant, or maybe you're going to be working as the manager, helping seat people, maybe waiting on tables, whatever it might be, whatever capacity. In all likelihood, especially if any of you ever start a business, you're going to work for that business too. Now you're the owner. And one way to think about it, all the factors of production in a market economy have to be voluntarily contributed to the operation of the firm. If you want to hire somebody to work for you, well, they don't really care about your business, and working is inconvenient and takes up your free time. So the only way you can get somebody to work for you is to pay them. You have to actually, you'll pay them, and they'll be an employee, and they'll be an explicit cost. But if you're going to run a business and you're going to own the business, then you're also going to be willing to work for it, because it's your business, and you'll be willing. You're going to show up at the business and you're going to work. But you don't have to pay yourself. You don't have to pay yourself an explicit cost to work there. But there is an opportunity cost. If before you start your own business, in all likelihood, you have been working for some other business. You could continue to work for some other business. So even though you don't have to pay yourself as the owner of a business to show up and run your business, you do have an opportunity cost. If you start a clothing store, you could have been working in another clothing store. Maybe you could have been the manager of another clothing store before you decide to start your own. So whatever you would have gotten paid, or that you could have gotten paid working for another business, doing whatever you're skilled at, that's a implicit or an opportunity cost of running a business. So the labor contributed by the owner of a business is an implicit cost. Another probably more important factor is the capital or money contributed by the owner of the business. If you start your own business, not only are you likely to work for it, you're also likely going to invest your money in it. You probably put your life savings into the business to try to help it work, to succeed. Owners of a firm can contribute capital. And in a corporation, this is the stock. The stockholders are the owners of the firm, and they contribute their capital to the firm when they buy stock. Now, whether you're the owner of a small business or a stockholder of a company, as the owner, you get to claim, you get a share of the profit if they make any profit, and that can be a return on your financial investment in the business, but you're not guaranteed that. You don't have to pay that out. If you're a corporation, you don't have to pay a dividend every period. If you declare a dividend, then you have an explicit cost. But if you don't, there's still an opportunity cost, implicit cost. If you invest $10,000 of your money in your own business, that $10,000 could have been invested someplace else. You could have bought stocks, bonds, something else with that, and earned a return. The money that you invest in your own business, if you're starting a business, has an opportunity cost. It could have made you money elsewhere. When stockholders buy stock for a company, they choose to invest their money in that company. They could have, say, bought a bond, or they could have lent it out to somebody through a mechanism of a bond, in which case they would be contractually obligated to receive interest payments. So again, probably the bigger from a total dollar amount standpoint, the bigger opportunity cost in our economy is capital, the investment that's contributed by the owner of a firm. Well, we have two ideas of cost. One would be accounting costs, and then economic costs. Accounting costs are going to be effectively the explicit costs. Accounting costs are how the accountant, if you started your own business and you take your books to somebody, how that bookkeeper is going to keep the books for your business. And that's basically going to include all of the explicit costs, because you'll have invoices, you'll have bills for those, you'll have made explicit payments, and that's going to be your accounting costs. Economic costs, well, because this is economics, we define costs in terms of opportunity costs. The opportunity cost would be the full value of everything that you give up when, say, you start your own business. So that would include both the explicit costs and the implicit costs. It would be the accounting costs plus the implicit costs. So economic costs are going to be larger than the accounting costs, because they include everything that's in the accounting costs plus these opportunity costs, these implicit costs. So economic costs are bigger than accounting costs. And that means we're going to end up to similarly have two ways we could define profit. We could define an accounting profit, or we could define an economic profit. The important thing to remember is that since the economic costs are larger than the accounting costs, when you calculate the economic profit is going to be smaller than the accounting profit. So a firm could be making an accounting profit. Accountants could say this firm is profitable, it's making a profit. But from an economic standpoint, we might say that firm's actually making a loss because they're not earning enough money to cover the implicit cost. as one example of it, there's a study that looked at like tech business startups. And the entrepreneurs that started these tech companies in the first year or so that they were working for their startups, this study was able to calculate that they earned about $5.89 an hour. And then that was how much profit their business earned, and that was a return on labor for the first year. Figuring how many hours they were working, they were probably working 70, 80, 90 hours a week. And so when you figure that out, well, if this is in the tech center, those are IT professionals, they probably could make $90,000 or $100,000 a year, and they're making less than minimum wage. So that would be a case where you're covering your accounting costs and you have an accounting profit, but that's what when you figure that out, you're not actually earning as much money as you would have if you've been working for somebody else. So that would be a case where we say that firm, that startup firm, maybe is making an accounting profit, but is making an economic loss. Two more ideas about costs that we're going to need to have. One is the idea of marginal cost. Marginal cost is just the cost of producing one more unit of output. So if you're currently producing 10 units of output and you choose to produce an 11th unit, the marginal cost is how much it costs you to produce that 11th unit. How much extra in the way of inputs do you need to have to produce one more unit of output? And then finally, we have to introduce, I want to talk about average cost. Average cost is cost per unit. So if you have the total cost, and you know how many units of output you've produced, it's just the cost divided by Q. It's a cost per unit. So if you've produced 10 units, and then you could calculate, what your total cost was. Maybe your total cost of producing 10 units was $500. Well, it'd simply be 500 divided by 10, and you'd have a cost per unit or average cost of $50. So we need to be clear about both of these concepts: marginal cost and average cost. They're both going to be important when we try and figure out how it is that a firm's going to behave. So that's some ideas of basic ideas of costs.